What's up, everybody? Jamel Gibbs. Welcome to the Deal Pro podcast. This is, what's today?
Hold on.
Wednesday. All right, let's start that over. It's
It's
Jamel Gibbs. Welcome to the Deal Pro podcast. Listen, we have the triple threat in the building right now. We got, obviously, myself. Then we have Mr. DeAndre Clayton.
Nice to see you all today.
And Mr. Anthony Rushing.
What's up? How you doing?
Yeah.
So listen.
Thank you.
So I've done podcasts with both of you.
Mm-hmm.
Some of the most viewed podcasts that I have on the channel. It's a fact. And just by chance, we happen to be in the same building today.
I know. What are the chances?
Who'd have thought?
No, so Anthony flew all the way out here from Nashville. Shout out to Anthony. And DeAndre, I see him all the time.
Yeah.
He's right here in the local area.
It's just life. Yeah.
But we're going to talk to you guys today. There's a ton of comments that came in on the channel. I want to definitely go through some of these comments and just address some of the thinking in these comments. But in addition to that, just kind of talk about how we can help more people make more money, man. Is that cool?
Yeah,
Absolutely.
Yeah.
So why don't you introduce yourself?
Hey,
DeAndre.
Well, hey, you know me, DeAndre, known as the infinite banking guy. And, of course, I've been doing a whole bunch of these HELOC consults because of this guy next to me. But just helping people look at the numbers, helping people get out of debt, helping people to invest smarter, scaling smarter. That's my whole goal for anybody who's watching the podcast.
Yeah, man. Anthony?
Hey, Anthony Rushing. I formally I'm a loan originator and sales manager.
And a fiddler player.
I am a fiddle player. That's true. I was a fiddle player. I don't claim that in Nashville. People ask me in Nashville. I say
you don't talk about.
Well, I say I play the fiddle, but I'm not a fiddle player because it comes with a whole different context.
Oh yeah,
Yeah.
in Nashville.
In Nashville, other cities, I
Yeah.
claim it, but not there.
Understood.
But formerly I work. I'm a loan originator at First Savings Bank, but specialize in a first lien HELOC product and educating people on how to best use it. And a lot of times we teach people how to aggressively pay off their loans, pay off their homes really quickly, but also use the product for other purposes, for investing, for creating, a cushion per se, and security for their families and future wealth building as well. So yeah, that's really what I specialize in. I guess if you're the IBC guy, then I could be considered a HELOC guy, right? Yeah. But yeah, first lien HELOC, that's kind of what I specialize in. So
First lien HELOCs and insurance and IBC.
Yeah,
and all
insurance
kinds of stuff.
planning overall. Insurance planning.
And real estate
budgeting, all kinds
investing
of
right
stuff.
here. So we really have, this is really everything that you need in one room, which is incredible. Would you agree with that?
I do agree.
We need to do a seminar, man. Stop playing.
I think it'll be
a lot of
awesome.
people been asking. I'm gonna be honest. I did a video with DeAndre, one of our first ones when we had Reggie on, and you got to see the amount of people that actually want to have a seminar.
I thought it would be great.
You guys want a seminar? Let me know in the comment section.
That would be great.
Well,
that would be fun.
I think it'd be great too because the questions that we're going to address today, the way we have to do it is we receive the question after the fact, and the only way to really address the question is to then come and do a podcast later on afterwards, right? Where what I find is it can be really powerful when people have genuine questions about something to ask in front of the group. And you know what? If they pick it apart and they pick the whole concept apart and blow it apart, good for them.
Yep,
right?
exactly, man.
But the reality is that what I found is that it's really great to provide immediate feedback to people. So when people have a question in front of the group, then to have an answer that is able to help answer the question that they've got can help realign their thinking, in line with the way that the direction that we're going to, but also can fix misconceptions in real time.
Most of the misconceptions that come through in the comment section is due to shorts, YouTube shorts and short 1 minute videos. So people they
snip what they want.
They snip what they want out of a 1 minute clip, and their comment is always correct. So my man DeAndre has a message for you guys.
Well, so my message is when you are on YouTube, there are some rules on how to watch a podcast. Number one, everything does not apply to everybody, right? So sometimes you're watching these podcasts, you're looking at it. Oh, well, it doesn't do that. Oh, you can't do that. Well, one, in financial services, we recognize that each person we meet is different and has different circumstances. So sometimes, like I've seen on the infinite banking ones where they'll say, oh my goodness, how could a person spend $30,000 a year on an insurance policy? Well, you may not know people who have that type of money. And if you don't, that's okay, but don't shoot it down as this is some kind of impossibility.
Right.
So that's number one. Or you hear some stuff about the HELOC. And most of the time, people don't know the budget of the person you're sitting in front of to develop all of these different case studies that you have. So I can definitively say there are times when paying double the mortgage could work. Yes. And there are definitely times when paying double the mortgage is not going to be more effective. I have some clients who make $35,000 a month and their expenses are $10,000. Guess what? The mortgage is $4,000. I'm sorry to tell it to you, but double the mortgage is not going to work better. It's important that people understand that because they think that you're trying to lead them in whatever type of way. Now, the next thing I want to say is...
well, can I hop on that just a bit?
Go ahead.
Because I think that I agree. And one thing that I've noticed about you, DeAndre, and Jamel, yours is a little different because you have a model that will work. Mm-hmm. For if you follow the model and it will work for you. You do these steps and you look at these numbers and it will work, right?
100% of the time.
It's not the case for you,
right? Absolutely.
And it's not the case for me or for the first in HELOC. So if the perception from
just to add on to that, the model works, but there's a lot involved in it as well. You got skill sets, you got, experiences, you got how much money is available to people. I got a video on YouTube, it's kind of tying in with what you were talking about, how, it doesn't apply to everybody, right? Mm-hmm. So I have a video is how to buy your first rental property, even if you're broke. It's my most viewed YouTube video. It's almost at 3 million now, right? Nice. A lot of people watch that and they're like, man, this can't work or that can't work. And I'm like, what are you talking? I do this all the time. It doesn't work for you if you don't believe it doesn't work. Mm-hmm. Right? You know what I mean? Or if you don't put in the work to make it work.
If you don't put in the work.
Absolutely.
Yep.
So.
Absolutely.
Yeah. So, I think that one thing I've noticed about you and one thing that I try and do and I'm really purposeful with as well is to make sure that when I walk through my concepts, and I've noticed when you do the same thing, I try really hard to not present it in a way that is, hey, you have to do this. This is the be-all, end-all, right? Yeah. And I think that if that's the perception, then I need to work on the way that I'm presenting stuff, right? But I do try really hard to make sure to say, look, here's when it works. Here's when it doesn't work. Mm-hmm. The reality is it's just mathematics, right? And sometimes this math works to people's benefit better than this math does, right? Mm-hmm. Because it's just numbers, and there's a strategy here, there's a strategy here, and you've got risk tolerance, you've got understanding of how financial vehicles work, you have what's your end goal, you have what your cash flow look like. All those things come into play when it comes to what's the financial vehicle that you're or set of vehicles that you're going to use. And so the idea that, if someone says the math doesn't work, I can prove that wrong, right? Mm-hmm. But if someone says this philosophy is wrong, right? Well, what? Our portfolio at the bank is living proof that it's really good for a lot of people.
Well,
right?
They have to create the scenario to make it wrong.
Right.
That's the problem. Right.
Usually the scenario.
Right. Yeah, like if you don't have any cash flow, yes, velocity banking will not work. Let's go ahead and repeat that one more time. Velocity banking, first lien HELOCs are not for you if you don't have cash flow.
Meaning if you don't make more money than you spend.
Yes.
If you don't have a surplus. And I'm not talking $100 a month you have surplus. We're talking you make a good amount more than you spend and you're disciplined with your finances. If that's not the financial picture that you're living, there's nothing wrong with it. But this is not going to be for you. And so what we don't do is I don't try and sell this to everybody.
Right.
What I try and do is I find the right people who will fit with this. Right?
Which are
which are people who cash flow well.
There you go.
Yeah.
That's it. And there's nothing else to it.
Cash flow well. They understand a budget. They understand the in and out.
Yep. And they can stick to the budget. Right?
And they can stick to a budget.
So I didn't mean to cut you off there, but I think sometimes there's a perception that when the attempt is to educate people on a strategy,
you're trying to sell
that all we're trying to do, we're just trying to, hey, look, here's a thing, we're trying to teach you about it. It may be able to help you, and I'm not trying to sell you on it. I mean, is there an incentive for me to teach this strategy and find people who are good fits for it? Yes,
yeah,
right?
Of course. Absolutely.
But that being said, and we were talking about this earlier, our calls are more about finding people that it doesn't work and telling them not to get it, instead of trying to sell people when it doesn't work.
As a matter of fact, just to prove that, if you've been on a call with either Anthony or DeAndre, you've been told not to do it, leave a comment in the comment section.
Oh yeah,
because we want to hush the naysayers.
Yeah,
everybody think that somebody's trying to sell them something all the time, which is that is the case.
Somebody is.
But somebody is.
Well,
but we're really trying to provide you with value. Now, are our services free? No. Like, I don't provide free coaching. You asking for my time. I don't Deal Pro Accelerator program. Check it out.
Deal Pro.
But seriously, I don't provide free coaching. You can't get a free course from me. It took time for me to put that together. Do I provide free value? Absolutely. Look at it. Look at this YouTube channel. Look at some of the communities I put up. Look at the calls you get on with DeAndre. He's trying to find a way to tell you why it wouldn't work for you. And if it does, then he's happy to take you on as a client. Same thing with Anthony.
Yep.
So it's not that we're trying to sell you something. We're trying to provide you with the information. And if it doesn't work for you, we're trying to prevent you from hurting in the long run.
Yep.
That's what this is all about.
Yeah, absolutely. It's one thing that I want to be very clear to people, and this is something that I've actually transitioned into saying on all of my first calls, whether it be the first lien HELOC or whether it be the infinite banking concept using whole life, it's a privilege, not a right. Like, we want to make sure this is very clear to you.
And what do you mean by that?
So everybody doesn't qualify. It's something you have to qualify for. So I think sometimes when people, and it's amazing to me, especially that it applies to the insurance industry, like they say, if you're selling it, if you know somebody who's doing insurance, they're selling insurance. Mm-hmm. Well, let's just go ahead and get this out the way. You can't sell insurance to somebody who doesn't qualify for the policy. If you don't qualify, you're not getting sold anything, right? So that's first and foremost. Now, I can inherently go on anything that you invest in. You can invest without being qualified to invest. There's so many people who don't know what they're doing from, a standpoint of investing.
I had a comment coming on the channel within the last 2 weeks. It was kind of funny. I want you to address this because it was about you, man. It was talking about you.
Oh, I'm okay.
They were talking about you.
I got thick skin.
No, so so they said, what did this guy say? He said, keep insurance in insurance place and investment in investments place.
Wonderful. So on that particular video, I talked about buy term and invest the difference and why it actually ends up being a failure for the average person.
Before you get into that, why would you think that person would say something like that?
Because of lack of comprehension.
There you go. Right. Now, where's the lack of comprehension?
Well, the lack of comprehension is they hear what they want to hear in order to respond the way they want to respond. Because if you actually listen to the video, if you compare buy term and invest the difference, and I say, hey, buy term and invest the difference, it leads to failure, yada, yada, yada. Term is insurance. Term is insurance. Investing is an insurance.
Right.
But the other part that I think really needs to be stated is the ability to grow money does not require investing. You can grow money without investing.
Of course.
And I think a lot of people don't.
Savings account is a perfect example of this.
I think a lot of people don't think about that. They just kind of like, if I'm going to grow capital, like I've heard some podcasts, like a guy says, insurance policies with cash value. And then he equated cash value to investing. Mm-hmm. So really quickly, when you talk about insurance, the reason why it is not an investment, I repeat, insurance is not an investment. The reason why it's not an investment is because investment means to risk for the purpose of possible gain. A lot of you have been taught that high risk, high reward, that investment kind of jargon. But in reality, when you listen to high risk, it's talking about high volatility, which means there's a high probability of not making money. You haven't attached investing with that aspect that it's possible to not make money, right?
So you're saying investing is gambling?
Investing is totally gambling, right? Now, the only difference is
100%.
The only difference is that there's ways to mitigate loss. There's ways to actually be a little bit more seasoned. Now, the reason why investing can be gambling is because most of the time when people invest, they speculate. They're not necessarily investing. Like for you, investing isn't really gambling that much, right? Because you're investing in the real estate and you understand real estate. This is something I have to go over with almost every client when they call me and automatically because they saw me on the real estate podcast. I want to do real estate. They may not really want to do real estate. They want the returns of what they believe real estate can provide. So what I say is there's a higher profit margin in selling a dozen cookies. And they're like, what are you talking about? What I'm saying is flour, milk, sugar, you can invest in those and you can sell a dozen cookies at $10 a dozen.
Pizza.
That money that you've made on that is a higher profit margin in percentage than what you would get in real estate. And it was less risk. So I always teach people, get your cash flow up first in things that you are good at, right? If you're great at, this particular thing, do that first. Get your cash flow up. Learn the aspect of supply and demand. Learn what's going out. Learn what's coming in. Learn what kind of profit margin you want to set for whatever you want to set it. And then start saying, okay, I want to do real estate. Because a lot of people are trying to hop into real estate and they don't understand business.
Thank you.
That's a problem.
A lot of people look at real estate as a get-rich-quick scheme.
Yeah, they do.
And it's only because of what they're sold. It goes back, 30, 40 years. Guys are like, make money in real estate, no money down, courses, and all that stuff. It's possible.
Right.
I do it all the time. No money out of pocket real estate. But I've built up, again, skill sets. I do have access to capital.
Right.
When I first started, I didn't have money. I had $250, but I had skills.
Yeah.
You understand what I mean? So, I developed a skill set of learning how to speak to people on Wall Street before I got into real estate. So I wasn't necessarily starting from scratch. Even though I was. The reason why people invest in the coaching programs.
I would take your skill set and that amount of money over a lot of money and no
over a lot of money with no
Absolutely.
Skill set. Any day.
It took me a year and a half to learn how to make money in real estate, though. 13 months, first 13 months, on that 13th month, I made $1,500 by accident. This next check was $48,000. You know what I mean? So, and I'm 21 years old. But here's the deal. When people say no money out of pocket or no money down real estate, or in my case, I got YouTube channels that say even if you're broke, you don't have to, broke is a terminology and people don't really understand that. Broke is a terminology.
Sometimes it's a mentality.
Sometimes it's a mentality. Very, very true. Very true.
Sometimes it's a mentality.
And you took the words right out of my mouth, because sometimes it's a mentality as well. But at the end of the day, because you might have a broke mindset, if you have a broke mindset, you'll never make it work. That ties in to
never make it work.
What the person was saying, and keep investing in place and et cetera, right? But if you have an abundance mindset, you can buy real estate with no money out of pocket.
Yeah, right.
We discussed wholesaling real estate earlier today.
Yeah,
it doesn't require you to have money to do that. Another thing when it comes to no money down real estate, when you're structuring these deals, so the no money down situation comes during your negotiation, not not physically putting the money out of your pocket.
Yep.
Right.
It's how you negotiate the deal.
Right.
And here's where I was going with it. Most people don't want to invest into the education to learn the skill set that's going to take for them to be able to do that. Mm-hmm. They just hear even if you're broke, and they're like, well, I'm broke. I want to do this too.
Right. Yeah. Or they're willing to spend the money for the education.
Some people are just not willing to do it, man.
Right. And
they'll rather go buy a pair of Jordans.
You were mentioning this earlier where you talk with people that have $20,000, $40,000, $60,000 of debt because of the multitude
bad education.
Because of bad education, or because of a habit of believing that just taking the course is going to get you.
You got to do the work, man.
Right. And so just taking the course doesn't get the money. It's the action that you take. It's the risk that you take. It's getting out of your comfort zone and going and getting it done.
Your coach ain't going to do it for you, man.
They're not. And it's you putting yourself in the uncomfortable spot to do the things that it takes to get it done. Because, I don't know many, you walked in, we're talking about it more, but I've heard multiple stories of people, and it's unfortunate because, for one, I think one of the perceptions is that the people that are offering the courses are offering subpar courses, which I would agree are out there.
Yeah,
right?
there are.
But there's an offering that people are out there promoting, right? Mm-hmm. And we can say it's all the bad coach, right? Mm-hmm. Or we can say it is all the person, right? It may be a myriad of both, but the reality is there is coaching out there that isn't great, that doesn't get the job done. But there's coaching that's great. I was telling you about my first year as a loan officer. I didn't know anyone, not one person, and I had an amazing coach, and he was like, look, you need to call enough realtors every single day to get 3 coffees a day with a different realtor every single day. And I said, so that's the goal, right? And he was like, no, that's not the goal. He's like, that's the job. And I was like, oh crap.
You know what my main thing similar to that? Yeah. I make people make 25 offers. If you make 25 offers today, what's the chances of you getting a deal?
Today, I mean, it depends.
If I told you no experience today, go and make 25 offers. If I told you to go make 100 offers.
But so the thing is, I hear that, right? And I think about the work that's involved with that, right? I think about the number of people that are going to follow through with that amount of work to get the job done. And that's the thing is that human behavior is one where people naturally don't want to get out of their comfort zone, right?
People don't,
They don't want to change. They don't want to feel like a risk. Even if there's no financial risk, they don't want to risk their pride or go into this zone of fear, right? And so they'll avoid the things that are hard, where it's like, if it takes putting in 25, if it takes putting in 100, if it takes putting in 2,000 offers for you to guarantee, from a statistical standpoint, for you to make $1 million, $2 million, whatever it is, right?
Pick up the phone.
Most people though wouldn't do it, right. And then you got your not even 5, probably 4, 3, 2% of people would do the work that it takes, because that's the only reason why you've got your people who make it from nothing, because they're willing to put in the work to get it done.
Yeah. Statistically, in hot markets with a ton of competition, statistically it's going to take you about 25 offers from not knowing anything about real estate to get one deal. If you know what you're doing, between 7 and 15. That's why I tell people to make 25 offers. Yep. And if they listen, everybody who listen, you see the YouTube videos. They got a deal. If you didn't listen and you made excuses.
So I think my first year, right, as a loan officer, we were on a 12-week call cycle. Mm-hmm. And I had to call the same people for 12 weeks and ask them.
Same exact people.
Same people, right?
Follow up. Because I just did a study on this, man.
There you go. Because apparently after, you get no's, and after between week 8 and week 11, you have the highest likelihood of getting a yes. And after 12, they drop off, because if they tell you no for 12 weeks, you're going to get the no forever, right? Yeah. And so I think one of a couple things happen. Either you break them down, and finally they agree, right? Which is okay, right? you call enough, and then they know who you are, right? Mm-hmm. And then they're like, you know,
relationship.
And even if you're leaving voicemails, like I've got your voicemail for 8 weeks now, right? Or they realize that you're consistent enough, and they respect it, right? And then they're willing to give you a chance, right?
Thank you.
But that was tough.
Yeah.
Like, because here I get 6 weeks through, and I get, most of the people aren't happy that I've called them 6 weeks, right?
Yeah. Yeah.
And I'm just asking for them to meet me.
You're just cleaning the list, though, man. That's what you're doing.
That's it. And I had to go into this zone where there was no fear, there's no pain. It's like I turned into this like robot, and I'm just calling and calling and calling, you know.
Next one.
And it seems it at that point I didn't know anyone in town. Right, and I had to scale, and I had to feed my family. So I was like, "What do you have to do to get the job done?" And it worked, and it was good. But that's something I think that it's hard. It's really hard to do. It's hard to put yourself there. And I think that there's this allure with coaching programs that the coaching program is going to make it work. It's like, no, the coaching program
is to guide you.
The coaching program is going to give you the knowledge
and the resources
for you to go do it.
That's it.
You know,
and I will say this: part of that allure is probably from what the financial industry has started for people. Because when you think of the financial coaching, whether it be financial advising, financial planning, what it's done, unfortunately, for the average American is take stewardship out of their money. Like, they no longer think about, well, am I making a smart investment here, or am I doing this the right way? It's, hey, here's all of this. You just tell me what to do, right? And then if I fail, it's your fault. Instead of, if I fail, it's because I didn't do the due diligence to say, you know what, that part right there didn't make that much sense to me. Maybe I should do something differently, right? And I see that all too often. Like, if you look at any infinite banking podcast, part of the biggest kickback is that people can't think conceptually because they can't think about them performing action, right? It's, okay, so this guy is telling me to take a loan out against the policy and then invest in real estate, or this guy is telling me to basically create my own investment and create my own comp from the investment. Because that's really all of us are saying the same thing, right? As far as infinite banking. If you take the policy, you have a better arbitrage because it's a lower loan rate, but it's also continuing to grow while you're using the money, right? But the person says, well, why wouldn't I just put my money in the market? Do you even know if the CEO just broke up with his wife of whatever company that you're invested in? Do you know the companies that you actually are invested in? Majority of the time when you meet with a person, they have no idea.
We just had this conversation about me and crypto earlier today.
Right. Which is why I say that they're not investing. They're speculating, right? It's funny because, like, and I'm not knocking this as a fund, like when people buy ETFs or different things like that, basically it's like a spread of different companies. That's not something that Warren Buffett actually subscribes to. And to me, I'm like, I'm always, who is the best at this, right? If you listen to the average advisor, they're not advising you to be like Warren Buffett. They're advising you to trust them, right? So,
yeah, it's true, man.
Yeah.
So Warren Buffett tells you that diversifying doesn't make sense. You know why he says it? He says, if you actually knew what you were doing, you would have no need to diversify. You only diversify to minimize risk. Risk is a lack of knowledge. When you know,
that's exactly what
you don't diversify.
There you go.
Right? Which is so interesting that people really don't catch that. But
I'm two things. Going back to your follow-up thing, that study I was telling you about. It says when, let's say for example, you're doing direct mail.
Yep.
Right? When you're doing direct mail, expect a 2% return rate
2%.
on the first mailer, right?
2%.
2.
Yeah.
Then it goes up to like 4. Then it goes up to like 5%. Then during that 4th or 5th month, they said between months 5 and 12, you're gonna go from a 10% to 81%.
What?
Yep. I did this information. I will actually put it in my new wholesale course. I did the research on it. You jump from a 10% response rate to an 81% response rate between months 5 and 12. And then after that, like you said, it drops off.
Because they done seen it so many
crazy
times.
numbers, man.
That is crazy.
Crazy numbers. I'll send you the data.
Please do. That's awesome.
Number 2, the reason why that happens is because you're building relationships with people over time. Look at what McDonald's. Remember, look, just a few years ago, McDonald's was running a commercial every 15 minutes, give and take. Why do you think they're doing that?
Stay in front of you so
Stay
that
in front of you.
mind,
They're building. They're subliminally building a relationship with you over time.
Mm-hmm.
That's all they're doing, right? So when you think about eating now, you're gonna think about them. Number 3, I said 2, but number 3, you were just talking about. Refresh my memory.
Warren Buffett talking about diversification and risk.
Diversification.
And risk.
Right?
Yeah.
So with diversification, and this is pertaining to real estate. This is a real estate channel. It's a financial channel at this point. But so when it comes to real estate, you got something called shiny object syndrome.
Mm-hmm.
Right? Shiny object
That's
syndrome.
everything. Yeah.
So now you hear about wholesaling, you hear about rehabbing, you see this guy making money through Airbnb, this other one making money on Verbo.
Tax liens.
Tax liens and all this other stuff.
Tax liens.
Right? You know what the problem with that is? You got too many options, you're not going to make one.
Yeah.
You're not going to make one choice and you'll never make money. So when I tell people, especially with my coaching clients, Deal Pro Accelerator program, I tell them all the time, look, pick one thing. Let's
Choose
get
a
really
niche.
good at one thing.
Yep.
Right.
Even marketing. Pick one marketing channel, master it, then add another one. You should have 5 marketing channels at all time.
Mm-hmm.
But pick one. Get really good at one. Get really good at one strategy.
Tunnel vision.
Yeah.
Tunnel vision on one thing. That's how you're going to master it.
Yep.
If you got too many options,
Well, then it becomes second nature too.
there you go.
Mm-hmm.
Then you're not on a learning curve.
That's
anymore.
how I'm able to do everything in real
Yep.
estate because
Right.
it took me
Same.
24 years to be able to do it.
Yeah.
Right.
It didn't happen overnight. I got really good at rehabbing houses, got really good at wholesaling, got really good at finding deals and building up cash flow. Now I'm a master at my game. It's just, it is what it is.
That's a fact.
I was thinking about to go back to that comment, right? To keep insurance where it is and keep investing where it is. I wonder where the drive for that comment came from, because for a long time when I was first learning about velocity banking and using the strategy to aggressively pay off the home, that was the world I lived in, right? And that was it was a tunnel vision. It was very in a vacuum. First thing HELOC is the best thing ever because it's new to me and I know who it works for and this is it. And the other things like infinite banking compete with this, right? And people who are financial advisors see this as a competition to what they're doing, right?
Yeah.
Because you have to cash flow well to be able to do infinite banking, right? And you have to, and financial advisors use people's cash flow to invest, right? And in order to succeed with velocity banking, you have to have cash flow. So each one of those, if that is your mindset and you live in a vacuum in that world, yes, everything is going to be competition for it. But again, you talked about abundance mindset, right?
Yeah.
If you have a mindset that's like, wait a minute, hold on. These are all financial vehicles that work differently, right? You have infinite banking that, yes, requires cash flow, but it follows certain rules, right? And then you have a first lien HELOC with velocity banking that follows certain rules, but they're different rules, right? And then you've got real estate or you've got investment on the side to generate wealth as well. That is a different structure. Surely there's a way that we can find how to leverage the differences to our advantage, right? And so when I hear comments like that, and this may not be where that comment came from, when I hear that, my initial reaction is one where it's like, what I think is that maybe that person is not coming from an abundance mindset was like, wait, there's a way to make this work together, right?
Mm-hmm.
It's like, no,
Absolutely.
this is what I know. Maybe they just learned about it. Like, no, this is what I know, and this is how it works, and this is the only way to make it work. And I'm going to teach this in a way that this is the only thing possible. Well, we talk about that. That's not right.
Yeah.
No financial strategy is right for everybody.
No, yeah.
And so, like, it's like, keep this where it is and keep that where it is. That assumes that model's best for every single person in the world, and that's wrong. That's completely wrong because different structures work for different needs and different goals.
That's right.
And so, like that for me, that comment is, and again, I don't know where it actually comes from, but my gut tells me it comes from a place where people think that this is the only thing that can work.
Yeah.
Maybe because this is all I sell and that's all I care about.
No,
right?
that's the
And
truth.
it's a lack of information. Like, I think people, when they make comments, they're speaking only from the amount of knowledge that they have, obviously, right? So, as I said, I don't believe insurance is an investment. Could I make an argument for it? Well, there's companies that do what is called life settlements. Now, you guys can look this up. Now, life settlements is when a company uses a self-directed IRA to invest directly into people's life insurance death benefits. A lot of people don't know this, right? So you got a surrender value in the policy, and then the life settlements company says, hey, I'll come by and I'll pay you 7 times your surrender value, and I'll start paying the premiums on your life insurance policy to be the beneficiary on your policy. Now, when you hear all of the rhetoric like, oh, keep insurance where it is and all that kind of stuff, people talk about insurance as if it's not an asset. But the reality is death is imminent. Like, it's going to happen. Mm-hmm. So I'm going to tell you an example of a client who actually invested in insurance. What she did is invested in insurance on her parents. She got insurance, $250,000 on each parent, and she was paying the life insurance policy. Parents died 4 years later. Had $500,000. Guess what she started doing? Buying up real estate. Was it an investment? You dang right it was an investment. How much in premiums did she spend? Somewhere around $40,000. What's the return on $40,000 and $250,000?
Right.
So, you have to understand context before you comment, because one, you just don't have enough information about an industry as a whole when you're talking about insurance in general. Because there are different ways that people utilize it to do so much more than you could ever imagine, which is why banks invest in it, which is why, I mean, there's so many people who are using it. But the other portion is when 2008, 2009 happened, there were 3 small insurance companies that needed to be bailed out. There were over 92 investment companies that needed to be bailed out. Your Fidelities, your Edward Jones, okay. So let's
not talk about the mortgage industry.
Yeah, we're not talking. We're not even going to talk about the mortgage industry.
I wasn't in there though.
I'm gonna let you live. I'm gonna let you live. We ain't even gonna talk about the mortgage industry because that was just vast. So you're talking about a industry that is solvent, that does not practice fractional banking, right? So you're thinking, oh, well, why would I put my money in there? When you put your money in your regular bank account, what's the actual support behind it, and so I want people to understand that it's far more than what they think, because they only think that investing is the only thing you can do with your money. Right. Invest your money. Now, here's another thing. I also, because this frustrates me too. It's soapbox day, right? So everybody talks about how often whole life policies actually lapse, right? Lapsing is not always the issue of the company. Many times that's a user error, right? But let's go ahead and kind of uncover something. The lapse on the terms are at 80%. Hence, 80% for the lapse on a term. I'm not talking about the lapse due to the term ending. I'm talking about clients actually stopping the premiums on their term. So now if your premiums are just so low and you need to put your money into your investments and you stop a $50 premium, a $100 premium, this is not an issue with the insurance industry, people. It's an issue with your relationship with money, right? And you have to look that in the face and say, well, dang, I really don't appreciate what this is, because, I mean, if somebody told me they would insure me for $1 million for $100 and something a month, to be worth $1 million because of $100 and something a month, like, put that into context. That's a privilege. That's really a privilege, right? So I like for people to kind of really understand what it is that they even are giving up. When people are giving up a term, when people are giving up a whole life policy, that's crazy.
Let's tackle some of these comments, man. This one came on the how to pay your mortgage off in 30 years. How to pay off a 30-year home mortgage in 3 to 5 years. A video we did.
Yeah.
Right. So this guy says, why not just use a 401k loan in place of a HELOC? Government 401ks, TSP are offering these loans at 4.3. So this is the problem, because we had this discussion. They're looking at the interest rate and saying this interest rate is better than what the HELOC rate is going to be. So
which if that's all we're looking at, if that's the only thing that is part of the picture, right?
This is exactly what he said. 4.375%. So you could get the loan or the line of credit at a lower rate.
So let's just say, like, let's look at that, right? That comment, right? Right now we're presented with a little bit of information, right? You have a loan from your first in HELOC, and you have a loan from your 401k, and the assumption is that they're exactly the same in terms of purpose and in consequence in terms of borrowing the money. And the only thing we're looking at is the interest rate, right? I don't know if that's true or not, because I know about the first lien HELOC, so I can't really speak to the 401k loan. But my assumption is that because they're not the same financial vehicle, they're not the same financial vehicle, which means that they work differently. I don't really know how, like, I mean, I'm just, I state a fact to support a fact. That's the best way to do it, right?
That's right.
But, there was one movie where he was like, man, I think you just made a fact. Like, it was awesome. But what's the difference between the two? And again, it may be a valid point. So, like,
No, it is a valid point, but when you look, in a short term, maybe, right? But when you look at it from a,
like, what are the differences between the two vehicles?
Look at it from a holistic standpoint.
That's
look
what
at
I
it
was
from
gonna
a macro view. So, first and foremost, 401ks have a provision for loaning. That does not mean you should take loans from your 401k. Just because you can doesn't make it right. I just want to make sure that's clarified. So, when you borrow from a 401k, let's use an example. You need 20 grand. You take 20 grand from your 401k, what is the first thing that happens? Well, when you borrow from it, remember it's a deferred vehicle. You're taking a post-tax loan on a deferred vehicle, which means you're technically paying taxes on the money as you're paying it back anyways.
So for one, you're not just borrowing at that 4.75.
So you're
paying a tax penalty along with borrowing at 4.2.5%.
You're paying the taxes up front, and
so that
then
wasn't
you're
mentioned in the comment.
On the back
No, it wasn't.
So they don't say that, right? They don't understand that, right? And then the other portion of
or from lack of knowledge.
Yeah,
or
lack of knowledge.
Fair enough. Yeah.
When you borrow from your 401k, there's a few things that happen. Your cash flow drops. I don't know why anybody doesn't mention this. They start taking the loan payments directly from your check, right? What's the other thing? Well, the 401k moves that money to the general account so that it can't grow and it can't lose. This is a retirement account. It is not a savings vehicle.
So we were talking about this earlier. The way I compare that is, I've got my E-Trade account, and when the money's actively investing, it's following the market. And when I trade, I win 100% of my trades. Which is not true.
Deal Pro.
Deal Pro Accelerator.
That's not true. Don't follow my trading advice, and I don't give
hilarious.
it. But it's in the market and following the market, right?
Mm-hmm.
But then when I sell those assets, it goes to cash, right?
Mm-hmm.
So essentially, what you're saying is when you borrow your money from your 401k, you essentially take the money out of it following the market, growing if you're growing over the long term,
Mm-hmm.
right? And pulling it into cash, where if we think about inflation, it's actually, from a dollar amount, it's stagnant, but from a value standpoint, it's actually losing value at that point. So that's another place where you're losing. So so at this point, you're losing because you're not gaining in the market anymore because it pulls it to the general fund. You're losing you're paying interest on it, and it's post-tax. You're paying tax penalty as well.
Yeah, and in fact, this is such a real bad situation of using the loans and withdrawals the way that they use them on the 401k. If you look at Fidelity's Q3, so they have a I guess what do you call them, announcement, or when they give you a report. So they gave their report for the Q3 of 2013 to 2023, right? Now, that's 10 years. Now, that 10 years, we were in a bull market. When you actually average their numbers on the growth of their average account, it states that it is 2.1% when you do the math per year. Now, why is it that? Well, the reason why it's that is not only the volatility within the last year, but also if you scroll down the page a little bit, you're going to see it make a highlight as to why the performance isn't good. Guess what it says? Loans and withdrawals, people. This is serious.
So it sounds like, if this comment, and this comment could have been a very genuine.
I believe it was a genuine.
I believe it is.
And
I believe it is a genuine question.
Sometimes it kind of feels like they're, what's the context of the comment, right?
Right.
But it seems like a genuine comment, which tells me that it comes from a place where there's a general consensus.
I think it's just a lack of knowledge,
lack of
understanding.
But kind of what you're saying too is that there's a general consensus that the 401k vehicle is one where
It's a savings vehicle.
that people think that they can borrow from and use it, and it's a safe vehicle to borrow from, where really there are three places where you get penalized. And not only that, you're paying yourself back, and you're paying yourself back interest. At the same time, if the average annual growth for 401ks with Fidelity is 2.1%, compared to what happened over the past 10 years in the market in general,
During a bull market,
that would suggest that there's rampant borrowing, that the general idea is that this is money that I have access to, instead of treating it like something that I don't have access to. I'm never going to touch it until I have to retire.
They treat it like emergency funds.
Right.
I meet with people all the time when I ask them, what are they saving per month and all that kind of stuff. They talk about their 401k first. So people are literally going through the aspect of, I'm going to lessen my cash flow taking a 401k loan rather than actually setting aside money every single month, because I can't afford to set aside money every month. Well, why am I doing that? Because I'm investing in stuff I don't understand. Right? So now that I've pushed all my money into this vehicle and I haven't met my savings goals, well, I just got to use it as a savings tool. And then they don't have any retirement at the end of their life.
Yep.
Right?
Here's another one, man. It says if you have low interest rates, which is between 2 and 3%, then making extra monthly payments or annually towards principal only will bring down the tenure of your loan, which is true, right? But it doesn't necessarily, and this is towards you, by the way, doesn't necessarily mean that it's better. It says there are tons of amortization calculators available online, and you can schedule what fits best to your needs. Using HELOC to pay your mortgage is a risky affair and needs a lot of discipline to do it right. What do you think, Anthony?
I agree with that wholeheartedly.
Me too.
Because and if that last sentence wouldn't have been in there, I wouldn't necessarily, because that covers exactly what we teach.
Exactly.
It requires a lot of discipline. No question. You're right. Now, if you have a lot of discipline and you cash flow, and that's your habit, and that's your lifestyle, and that's your routine, that's how you function, your cash flow creates security against the risk. Your ability to live below your means and consistently make more money than you spend covers for the risk. But if you can't do that, this is really dangerous. I like that comment a lot. I think that it goes a little bit further than I would, right? Because I have an incentive to advocate for the product, right? And for the concept. So there's sort of two parts, right? The end part I completely agree with, right?
Right.
If we're comparing, this is a common argument that we get where you're comparing overpaying on your mortgage against the first lien HELOC strategy, right? Where you're leveraging everything. And people, one comment I get is, people start to understand more and more about this, and there's a certain part where they make this connection, where they say, wait a minute, like, couldn't I just put everything into my mortgage, and my mortgage has a lower rate, and wouldn't it be less expensive? And the answer is mathematically yes, 100%. It would be less expensive because there is a lower rate. And so if you put all 100% of your surplus into your
where's the liquidity
mortgage, exactly.
But
right?
how is that
so
possible?
DeAndre, like from your standpoint as a financial advisor, because I'm not one, right?
Right.
If I came to you and I'm like, DeAndre, I want to do this. I got this idea, and I want you to tell me if it's a great, bad, or terrible idea and why, right? I want to take every single dollar of my surplus and put it into my amortized mortgage to pay it off as fast as possible, using everything I have in a place that I can never have access to again. Would you call that? Would you tell me to do that? Would you tell me you might want to think about it? Or would you say you never want to do that?
You never want to do it. Yeah, I mean.
So why? Yeah. Like the thing is like that right there, right, is why? Why would I not want to take everything that I have and dump it into my amortized? Because that's the argument, right?
Right. So
even in this case, just an extra payment, that's not taking everything, but it's going to take.
That's not taking.
It might cut a few years off.
Right.
But we're talking about paying off a mortgage in 3 to 5 years.
Yeah.
Right.
Well, the reason why is it sustainable, for one, right? So let's say we take this person who puts all of their money towards their mortgage. Is it sustainable? No. And why is it not sustainable? Partially psychologically. There's a sentimental aspect to your money. The way you feel about your money, it creates something in you, which is why there's not too many people who are paying double their mortgage or paying, even half on top of their mortgage. There's not a lot of people doing that because you have but so much finances and they have but so many purposes. So if I threw all of my money towards it that way, well, what about my emergency funds? Well, what about if I get sick? What if I have to have a surgery? Right? Where am I going to get the money? I might refinance anyways.
Which takes 30 days, and let's say you're out of a job at that point.
That's what they're going to do.
You can't refinance.
You can't refinance.
You're completely out.
And your credit is going to be shot.
Right. So if we're talking about going all in with everything, it sounds like, well, I would agree. It's not feasible. I would agree it doesn't sound like the safest. It sounds like a very, very unwise decision, right? Yeah. And then we want to compare this to doing an extra payment each year, right? Or paying 2 extra payments a year. Those are great strategies. Those will speed up your amortization schedule.
Even splitting a payment in half.
But exactly,
that helps
do
too.
biweekly payments. All those things are better than the amortized mortgage. But if we're talking about the most aggressive way to pay off your home loan is to find a way to be able to safely use everything, right? And the first lien HELOC, because every dollar that you put into it, you can take back out, it maintains that liquidity, right? It maintains your ability to be able to take it out if you get sick, if you have to, if you lose your job, right? If something happens, if there's an emergency, if you want to invest, right? You can cover for those unintended consequences of life that we all know will happen, right? And so it allows for you to leverage everything that you have to use everything to aggressively pay off your home. I mean, like I tell people, like, look, people ask, like, can I make extra payments to them? Like, Well, not if you're doing it right.
Not if you do it. There ain't no extra payments on
Like,
top of your income.
you don't have any
Except
money.
You got a bonus.
Like,
or
it's like,
something.
well, but that just tells me again they haven't completely connected
just
with the concept. Like,
payment,
can I make extra payments? I'm like, well, if you're doing it right,
there is no.
all your money's already. There's no money anywhere else.
Right.
Everything's already in there. Right. You're leveraging everything, which means you are controlling your pay down as much as you possibly can. It's the most powerful way to do it.
And also, from an interest rate perspective, I think a lot of people don't understand this about the first lien HELOC and the difference of the mortgage. The mortgage bases its interest on, or it calculates its interest on the previous month, which is why even if you made a huge principal payment, you would still have the mortgage payment anyway because it's already been pre-calculated for you. Inside of the HELOC, and I teach people this because it's important to understand math. If it's a simple daily average calculation, what's really interesting about that is, let's say you got $8,000 of income coming in and you got $3,000 of expenses going out. Now, the reason why it would be less expenses than you're probably thinking is because when you have a first lien HELOC, there's no more mortgage. It doesn't count. And I think a lot of you miss that, right? You just think, well, who's has this large of a of a difference in their cash flow?
Well, that's the difference between a first and a second.
Yeah.
Because here's the thing. Even if someone starts with first lien and then they say the word HELOC, right?
Yeah.
Most people, unless we go through the explanation,
automatically think about
are going to put the words first lien aside and they're going to hear HELOC and they're like, oh, it's a second lien HELOC and take my mortgage. And that's fair, right? So we're talking about a HELOC, an open-ended line of credit that refinances you out of your mortgage, right? So it's one monster HELOC, we'll call it, that absorbs the balance of the mortgage, right? It's a monster line of credit that's secured by your real estate, right? That absorbs the balance of your mortgage and then has a line. So your mortgage creates the new balance and then you have a limit above that, like any line of credit.
Yep.
So it's a much it's different than a second in that it's not on top of your mortgage, it replaces it.
And the calculation is not a monthly calculation. So you may be thinking, oh, this is the rate over here and this is the rate over here. Well, in the first lien HELOC, if I got $8,000 of income coming through, and then let's say I have $3,000 of expenses going out because we're not counting the mortgage anymore. Well, when that $3,000 comes out is also important too as to how much interest I'm actually charged, because it's an average daily calculation.
And when it comes out is important too.
So if I decided, hey, I want my $3,000 to come out on the 28th, and then I got 3 more days, the first lien HELOC is only reading 3 days of the interest on the expenses.
Yep.
So a lot of people are thinking, linearly on the interest. No, if it's an average calculation, it changes based on what you did throughout the 31 days.
That's right.
So it's important for people to grasp that, because if they don't, they ask questions like that and it's, it just doesn't make sense. And it's like, yeah, it does make sense when you base it on that.
And if part of it is understanding how the tool works, right? So
and
math.
You
have
to have a base.
Like the average daily principal balance piece, if I like to use extreme examples that don't really apply in real life, but that's easy math to allow for people to connect with the concept, right? So let's say you've got a 30-day month, right? And for 15 of those days, your balance is at $200,000, okay? And somehow you come across $200,000, and on that 16th day, you put it in the HELOC and your balance is zero, right? For the next 15 days of the month. So what you've got is a month where for 15 days, the balance is $200,000, and for 15 days, the balance is zero, right? They're going to take an average of all those days' balances. So 15 days at 200, 15 days at zero. So they're going to use a balance of $100,000 to calculate your interest payment, right? Because it takes the average of every single day's balances throughout the month. So the thing is, we've got 28 and 29 sometimes, 30, and then 31 days, a bunch of days in the month. It takes the average of all those days. So if you maintain a balance that's lower, if you keep your money in there without spending it, right, for the longer period of time, it creates an average balance using more days with a lower balance. So then you spend your money at the end of the month, right? And the balance comes up a little bit, right? And you get paid again, it dries back down.
Yep.
Right.
So I know this is, and I think I've asked you this before. Why wouldn't you use a second lien HELOC versus a first lien HELOC?
So, I mean, it's important to know I'm biased on this, right? So, I mean,
Of course.
know where I'm coming from. But so I will say that the velocity banking strategy using a second lien HELOC it was sort of the first one that was introduced, and it's really effective. It really is. The chunking strategy, and I'll go into that in a second. So that strategy.
It's manual.
It is. It's
manual.
But
it's
for
harder
first,
to do. Yeah.
it's harder to do, right?
But
So you're saying using a second lien HELOC is harder?
It is.
It's more steps.
But if we're talking about performance, right?
Yeah.
If someone has a really high balance on an amortized mortgage, right, and they've got a 1% rate, right, then chunking can make more sense from a payoff standpoint and from an interest cost standpoint. Generally speaking, even with a 2.5% or 3% mortgage, with the second lien HELOC strategy, it ends up being about the same. So the second lien HELOC sometimes beats the first, sometimes the first beats the second, but the outcome isn't strong enough to warrant choosing one over the other, if that makes sense. So in terms of the projected outcome, in terms of like what will happen if you follow the model day in, day out, they end up being about the same. Gotcha. So from that stand, it's important to say that because like that's true mathematically. But so so we built our first lien HELOC where, you got to here's the strategy: you get the money in the HELOC and use it to pay your bills, and it's that easy. And then whatever's left over stays in there, and that's what pays down your house. So the way it works with the way that we built it at First Savings Bank is you deposit to a checking account. And then there's a sweep feature that automatically pushes the money in the HELOC for you, right? So all you do is deposit to a checking, which is what you do already, right? And then you got to use the HELOC to pay your bills. So what you do is you write a check, or you swipe your debit card, or you set up an online bill pay through the checking account, or you pay someone through Venmo, and it pulls from the checking, right? Which then sweeps from the HELOC automatically. So the steps that you have to take, the process that you implement to accomplish the velocity banking strategy.
So it's less steps, basically.
Less steps, and it's fully automated. Now,
and less steps means less emotion.
Less human error.
Less human error, right? And
so
that's the important.
So let's talk about the second lien HELOC velocity banking strategy, which again is really effective, right? It's a smart tool. So this strategy involves pulling money from the HELOC and chunking into your amortized mortgage to pay that down. That accelerates, or that reduces the amount of interest costs, which increases the amount of principal that gets paid each month because it's a set payment. And we can go more into detail about that. But so that's why that's good. But then now you have to pay off the HELOC.
You still got to pay the HELOC.
Right. So then what you do is you have to drive the income into the second lien HELOC and use it to pay your bills, which in itself doesn't sound that tough. But here's what it looks like on a daily basis, okay? So you've got to get money from your HELOC into your mortgage, right? So for one, you have to log in and move money from the HELOC to your checking account. Then you have to log in, and then you have to move money from your checking account into your mortgage, and be specific to make sure that you write on the thing, this is a principal payment. It's not a reserve to go toward my next mortgage payment, right? Because they don't like you to do that, right? So they don't make it really easy to do. And so you have to be specific with that. But regardless of how easy or hard that is, that's the process to get the money in there. Well, now you have to pay off this $20,000, $30,000 chunk on your second lien HELOC. So your money gets direct deposited to your checking account. You log in and you move the money. You have to place a transfer to have the money moved into the second lien HELOC. Now all your money is in the second lien HELOC. No money is in your checking account. So now you have to pay for things like going to the grocery store and going to the gas station and getting a haircut and paying for your Hulu subscription and being proactive to get money back to your checking account before an auto pay hits, right? So now
it's a balance in that.
You have to log in and move money from your checking back to from your second lien HELOC back to your checking just so you can pay for your stuff for every single transaction that you're going to do for the remainder of like 7 years, right? Or 5 years. Now, 5 years is a fast period of time to pay off your house. 5 years is a ridiculous amount of time to have to log in and move money for every single transaction. And I'm telling you, like, I didn't try and make that sound complicated.
No.
Like, that's what you have to do.
What it is, right?
That's what you got to do.
Like, it's funny because when a person asks me, like, why would I choose it over the second? I don't know if you guys have you ever played cards? Mm-hmm. Okay.
Of course, man.
So have you ever had that one person that when they're cutting, they like cut a million times and it's like,
yeah.
That's how a second position feels when you're doing it, right?
Yeah.
It's just so much movement. And the more movement you have, the higher degree of human error. The more movement you have, the less likely you feel like doing it. The more it stresses you out. Oh, I got to get it back by now. I got to get it back by hand. And it's, that juggling, it's just not efficient for the average person because the average person makes a lot of mistakes. And because they love their money and because they have a relationship with their money, every time they make a payment, like that physical aspect of making a payment hurts. People, when you make a mortgage payment, come on, tell the truth. Tell the truth. You hate making mortgage payments. If you add extra, you hate doing it. Doesn't feel good. There is a psychological aspect to this, right? And so with the first lien, just taking out all of that and just being like, hey man, you got your expenses. You can even auto draft your expenses out whenever you need them. It takes away the thought process to make you think about other things.
I'll go a step further because a lot of people will chalk that up for convenience, right?
Right.
It's convenient, and that's it. And that's fair. I get that. Okay. But what I do know is that the reality is that no matter how great the goal is, right? Whether it's I'm going to lose 15 pounds, whether it's I'm going to work out so I can be as big as Jamel, so when people call, they say Anthony's the jack guy and not Jamel.
It's going to take a while.
So that really happens, huh?
It happens. Yes, they call and they're like, yeah, the African American guy who's stacked, the good looking guy, and I was like, I'm like, well, how come I can't be the good looking guy? Like, so anyway,
It's funny because somebody just reached out to me recently and said, man, you swole, man.
Yeah.
He just
real.
said, you swole.
That's awesome.
Well, my nickname for you, Swollen Power.
Swollen Power.
So I was like, I gotta hit the gym and the unattractive, small, weak looking guy. No, it's funny though. But no matter how great the goal is, the harder that it is to achieve that goal, the higher the level of failure you find. And so when the numbers work, which we make sure of, right? The reality is that the first lien HELOC product doesn't involve a change in your lifestyle. It doesn't involve a change in your habit. It's automatic. Process, procedures the same. With the second, you have to implement a whole new system of how you function. And people are excited at the beginning when they learn about it. They're like, I'm going to be in my accounts all the time, moving money. This is going to be great. Well, 6 months go by. This isn't new anymore. Right. 6 months, this is your life. And you have to
and
keep up with it. It becomes annoying, and people fail.
Gotcha.
And so, for me, if I'm thinking about feasibility and likelihood of success, right, to me, it's not about convenience. It's like, this is the number one reason for failure. And if we want to avoid that, then use a tool that's not going to add steps to get in your way.
One more. So this one was just spamming the comments with negative things to say. So here's one thing that stood out to me. This was in regards to somebody trying to understand what a HELOC was. We got plenty of content on YouTube showing you, or at least explaining to you what a HELOC is. But this is from the last video that we did. Well, not the last one. The one where we did, it says mortgage versus HELOC. Remember that?
Yeah.
And it's for both of you guys. So this person says, basically, you don't want to pay. So with a HELOC, you're going to pay more interest than on your mortgage. We covered that already. With additional fees, with additional risk, since HELOC rates tend to be variable. How do you guys feel about that?
Oh, okay. So first and foremost, and I think it's, once again, a scarcity mindset on this particular aspect, because when I hear people terrified of the variable rate of a HELOC, one, I understand being terrified of a mortgage or an ARM, right, that has a variable rate. But when you talk about a variable rate on a HELOC, rates could go down too. Variable means it goes up and down. It doesn't just go up only.
Right.
But the down portion is a reality, especially since we're in a bad interest rate environment, that there's a more likelihood of it going down. The next thing that I would say, and there was another part of that. Could you read another part of that?
Yeah, so basically what he's saying is, the HELOC rate is going to have additional fees. So the HELOC is going to have additional fees.
The additional risk part.
Variable rate, etc.
Okay, so the additional risk part, and this is also on the
additional risk
on the discipline aspect. So I want people to understand, when you make a comment about the discipline that a person needs to to use the HELOC, while that is true, you do need discipline to use the HELOC. You also need discipline to qualify for it. You need discipline to qualify for it, right? So you having the degree of credit score, you having the degree of debt to income ratio that allows you to actually qualify for it, it kind of weeds out a lot of the risks that people are thinking about.
You're already disciplined.
Right? Because you're disciplined enough to get it in the first place.
Right.
Now, I just really think that's important for people to understand. Now, the other thing is,
that's a great point, man. I never even thought about it that way.
Yep.
And the other thing is, I would state, when people define risk in the HELOC, I am a stats guy. So I don't go by what you think would be bad, because when people are saying the HELOC is risky,
numbers,
their standpoint is, well, if you got all access to all this money, what's going to stop you from just blowing it and get a Lamborghini, right? Now, the people who use a first lien HELOC.
I actually used that example, and I was on the phone with someone. I'll never forget this. The guy on the other side, he was like, so can I use this for real estate investment? Right. And I was like, yeah. And I like to go extreme, right? I was like, you have so much freedom. You could go on eBay and buy a Lambo with it. And he goes, sweet. Yeah. And I was like, how did I'm 30 minutes through the conversation. Right. And I was like, how did I miss this? I was like, I'm so glad I said that. And I spent the next 30 minutes convincing him not to get it. Right? Because I was like, that comment right there told me enough for me to know that this is not the product for you. I don't care how much cash flow. I don't care if we consolidate debt to create cash flow for you. The fact that you said that you were so excited. It was sweet. So I do use Lambo, but that was actually a brand new Bronco. You could get on eBay. This one they were out, right? You could get on eBay and use your home's equity. And I was saying it like this: you could use your home's equity to buy a brand new Bronco. And he said sweet, and I was like, oh no, no. And I'm telling you, I talked him out of it, because right there I was
flip the money up, man.
And here's the thing.
Real estate investing, Deal Pro Accelerator program. Take the HELOC money, and, you know what I'm saying?
Deal Pro.
He said, and then get the pro.
You know what I'm saying? Use the profits.
We should randomly just.
I know, Deal Pro.
Deal Pro.
I know, Deal Pro.
Whenever it is a Deal Pro. But that's one of those things where it's like, we have an obligation as
to save from themselves
as fiduciaries and as stewards of of other people's knowledge base, right? And to provide advice that's sound, that is going to help people's futures, right? Absolutely. Like we believe that, like, in our office, our vision is not about selling first lien HELOCs, because that's not what we do. We start with, we improve people's lives. That's right, and that's it. If what we're doing is not doing that, then we're doing the opposite thing of what we're setting out to do.
That's right.
And on that aspect also, from a risk statistically, so from 2014, how many foreclosures have you guys had at first lien?
None.
Okay. So
zero.
Now, I asked that question for a reason, right?
Zero.
We've
had one 30-day late.
Okay. So last year.
That's it.
One.
I want y'all to think about this. Last year, in 2023, the first quarter, first 4 months, over 100,000 foreclosures and 30-year mortgages. When we talk about risk, you can do statistics to tell what risk is. That's a mathematical thing. You can figure out what the actual risk is. So if you're going to say it's risky, what is your data that says it's risky, right? Now, if there were people who could qualify for a first lien HELOC and have a 500 credit score, it would be risky.
Mm-hmm.
But you know what? So this, there's another piece to this too, right? Which is that the risk that comes with it, comes with, are you a good fit for the product, right? And then are you working with people who are looking out for your best interest or not? The reality is that the reason why our numbers are that good is not because the first lien HELOC product works. No. It's because we vet crap out of people, right? And we make sure that their cash flow is where it needs to be and that their mindset is one where it works. So, you talk about qualification. Yeah, can you qualify for the loan? That guy might have been able to, right? But that's why we spend our time talking with them about teaching them. How do you function? What's your mindset? Do you understand what this is? Do you
the mindset is more important.
Do you understand the risks that come with this, right? Because and I'll go big time into the fact that you can ruin yourself with this. And just look, I don't know anything about your financial picture. I'm not assuming that about you, but I wouldn't be doing you right if I didn't say, look, like this is dangerous because you can overspend, and if you're not keeping tabs on it, no one's going to slap your hand.
That's right.
And you can condition yourself to overspend and overspend and overspend. And like we said the whole time, it's dependent on you being disciplined, right?
Yeah.
In terms of the risk piece too, I like to think the way I like to approach that as well is that if all things were equal, if you treated your mortgage in the same way you did a first lien HELOC, and you paid it down at a very similar pace, right? Yeah. Then the variable rate product would be much riskier. Yeah, that's completely true, right? Absolutely. And what I find a lot of times is that, and I name this, and people usually agree, which is that, and these are people on the phone, and I've talked to roughly 4 people a day for the past 5 years, right? for an hour long, right? So what I find is that people understand, they have an understanding of how home loans work. Right, and then they learn about this first lien HELOC product, and they learn about the specifics of it, but not the nuances of it, right? And the relationships of how rate and things like that work with it, right? And so then they ask questions like, they assume that a variable rate product home loan must be bad because their context, right? And the common knowledge that we have is all based on how amortizations work.
Based on amortization.
And so you touched on that earlier, which is that with an amortized loan,
it's terrible.
That here's how they work, right? It takes 30. You're paying interest for 30 years, right? And the balance stays high.
You're gonna pay 2.5 times more than what the house is worth.
There you go, right? And I talked to a guy at the airport today who said he's had 6 homes over the past 30 years, and he has never paid off a house. And you laugh, but that's the standard.
Real. That's reality.
That's the standard.
That's not the one-off. Yeah, that's not a percentage. Sure. That's everybody. But that being said, the amortization schedule is one where the balance stays high for a long time. So you're paying interest on a really high balance for a long time, and it takes forever to pay off. Well, if you have a slight change in the rate, that affects that home loan a lot. Well, let's just pretend out there that there's a home loan that you can pay off really fast, right? And let's just say that you can pay down the balance so you're paying interest on a very low balance within a short period of time. Let's just pretend that we've never talked about anything before, and there's a home loan that can happen.
That's too.
If that were true, then swings in the interest rate wouldn't change the outcome very much. Well, that's what a first lien HELOC can do. Yeah. So
swings in your cash flow will.
Well, look, man, this has been a great conversation.
It has.
In regards to all things real estate, HELOC, and infinite banking, and everything else in between.
And how to watch a podcast.
No, this has been fantastic, man. How can everybody get in contact with you, DeAndre?
ClaytonFinancialSolutions.com, man. I'm rocking out over there, staying busy as a bee.
Sounds good. And Anthony?
There should be a link down below. But if you want to check out firstlienheloc.com, it's a free educational resource for you to take a look at and learn more about it. So
perfect. And if you want some real estate coaching, you know where to go.
Deal Pro.
There you go. Deal Pro Accelerator program. Shameless plug. No, but in all seriousness, we're here to help you guys in your financial journey. in your real estate investing businesses, in your financial life in general. When you have all of the pieces in place and you have the triple threat in front of you, you can't lose, right? Well, is that true?
No,
if you're not willing to put in the work.
If you're not willing, there you go.
Yeah,
not willing to put in the work.
Yeah.
But we definitely appreciate you guys watching. I appreciate you guys coming out and joining the Deal Pro podcast.
Deal Pro.
And looking forward to much more content. Leave a comment in the comment section. Be sure to like this video, subscribe to the channel, click the notification bell, click the links in the description. Click the links in the description box. And we'll see you guys on the next one. Take care.